The economy is expected to grow by around 3.75% this year. Economic growth continues to be supported by increasing construction activity and ongoing strength in consumption and business investment. A high level of net immigration is also adding to overall demand and productive capacity. Economic growth is projected to moderate to around 2.75% next year due to the recent decline in commodity prices and the impact of policy tightening. The high exchange rate continues to restrain growth in the traded sector. The exchange rate is yet to adjust materially to the lower commodity prices. We believe its current level remains unjustified and unsustainable, and we expect a significant depreciation. The economy appears to be adjusting to the policy measures taken by the bank over the past year. But there remain risks around how the rise in net immigration will affect house prices and how much inflation pressure will increase as capacity constraints are met, especially in the construction sector. In light of these uncertainties, and to better assess the impacts of policy tightening and the decline in commodity prices, it's prudent to undertake a period of monitoring and assessment before considering further policy adjustment. Nevertheless, we expect some further policy tightening will be necessary to keep future average inflation near the 2% target midpoint and ensure that the economic expansion can be sustained. So thanks very much. We're happy to take questions. Net immigration's been stronger than what we were forecasting, and I think pretty well every other forecaster around town has been surprised by the strength of it. So it's currently running at around 41,000 on an annual basis. And if you go back to 2012, I mean, it was running zero, or close to zero, on an annual basis around that time. So we've spent quite a lot of time looking at the flows to see to what extent it reflects fewer people leaving the country, more people arriving. Those people arriving, what do we know about them? What's their age composition? Are they here on temporary work permits? And we also think about the impact on the housing market because this really is quite a significant net immigration inflow. If you look at the composition of people coming in, they tend to be, compared to, say, earlier immigration cycles, they tend to be a higher proportion of younger people, people without families, people here on temporary work permits linked to Canterbury construction, for example. And so we think that relationship between migration inflows and the demand for housing is probably a little bit different this time than previous cycles. When you do forecasting, you have to make an assumption around the exchange rate. So, for example, the OECD, when they do their forecasts, they forecast a fixed real exchange rate for the countries that they're doing the forecasts. For the IMF, they forecast a fixed nominal exchange rate. What we tend to do is we tend to say, well, look, if you've got an exchange rate overvalued, then over time you'll get mean reversion. The exchange rate will come back towards an equilibrium value. And so there's a technical assumption just about how quick that might be. There's, I think, an opportunity here in a sense, in that the market is assessing that the next policy tightening will be around April next year. If you look at the OIS pricing, it builds it in around April or so. If that is correct, if that turns out to be correct, then really the Bank of England and the Federal Reserve are likely to be increasingly focusing on their interest rate adjustments and policy tightenings around that time, and that debate, I think, will be even louder than it is now. So that will come into the equation as well. I mean, if you look at the last three major exchange rate cycles, say since 1985 or so, there's been three big exchange rate cycles. One, there's been quite a close correlation between the terms of trade and the exchange rate. And we're not seeing that in terms of this adjustment here. And secondly, when the exchange rate has come off, it's tended to come off really quite rapidly in each of those cycles. So we think that there is the potential for a significant exchange rate fall here. In terms of policy tightening, in essence, we have a mandate that requires us to try and achieve inflation of the order of 2% in the medium term. And it's something that we look at very carefully when we're making those policy changes around inflation. We look very closely at what's also happening to real growth in the economy and also what's happening to the exchange rate as well. So we feel that the inflation pressures are still likely to come through. The economy is growing, as I say, around 3.75%. Potential output's probably around 2.8 or thereabouts, we think. Will probably slow down in terms of growth to around potential output next year. But it still means that there are risks on the upside around inflation tied in with capacity constraints and also the construction sector. So we'll look at that pretty carefully. And we think that some further policy tightening will be needed. If you look at interest rates now, I mean, we've tightened 4 times, but they're still below neutral. I mean, we think the neutral interest rate's probably around 4.5%. So we're essentially about 100 basis points below neutral. So in that sense, we're still acting in a stimulatory way in terms of impetus to growth, even though we have tightened 4 times.